Welcome back. This week we have two big manufacturing reports. It really is the tale of two cities. First, the good news. The Empire State Manufacturing Index in the state of New York rose to a level of 9.1. Indications above zero indicate improving numbers and improving conditions. We can see here the red line, that's the S&P 500, the Empire State Manufacturing Index, which measures a general state of manufacturing in the state of New York, is at 9.1. This is the highest high we've seen pretty much going back to the beginning of the year, and it does correlate quite strongly with the S&P 500. When the manufacturing improves, so do stocks. Taking a look at the Empire State Manufacturing in yellow versus the 1-year bond in blue. The red line is a 10-year bond. We still have very much an inverted yield curve. Notice both of the yields are starting to decline, which is quite curious. We still have an inverted bond market, and the real signal is if the 1-year crosses back below the 10. That has been historically a very big signal. Hasn't happened yet, but curious how that when manufacturing was quite weak, we saw weak bond yields. Manufacturing's improving. Why are the bond yields sinking now? Here's manufacturing present day, again, back in positive territory after seeing a significant decline for the better part of a couple years. This is the longest lasting decline we've seen in Empire State Manufacturing, going back arguably to about 2007, 2008, but it looks like today's report is, a turn to the better side. Compare the manufacturing index in 2006 through 11. Again, 2008 and 9, we saw negative numbers. 2022 from July up until last month, really, we saw also negative numbers. Today's number is a bright spot, to be sure. Now, the bad news. The Philly Fed Index, the Philadelphia Federal Index Survey, it's a regional Federal Reserve Bank index measuring business growth and manufacturing in the Philly area, declined to negative 5.9. This is a general activity index, again, 5.9. It's better than the prior two reports, to be certain, but certainly still in negative territory. One of the only positive numbers we've seen lately was about 4 months ago. But since then, we've had negative territory almost consistently since the beginning of the inverted bond market, June of last year, 22. Here's the current report. The general activity is negative 5.9. Shipments down 17.9. The bright spots, prices paid, prices received, and they're very close. They're actually identical numbers. This is important because what has happened in the past is that prices paid, these are the prices that manufacturers have to pay for raw materials, was significantly higher than the prices received, the amount of money they were able to receive from the consumers. And that was a risk, a concern from the Federal Reserve that the manufacturers, for lack of better words, their profit margins were being squeezed because they were paying more than they were receiving. But that has equaled out, and that's a good thing. Also, taking into consideration our last two inflationary reports, CPI and PPI, both showed massive declines, especially the PPI in negative territory on a month-over-month basis. We spoke about this yesterday. That's a relief for manufacturing. Work hours down 700% on a year-over-year basis. Shipments down quite a bit as well. Everything else, well, it's a volatile number to be certain, but the delivery time is really the only positive spot in this year-over-year report. This is what the manufacturing index, the Philly Fed, looked like across all different sectors from 2007 through 11. Notice this dip into negative territory, and then we move back to the upside. The brown line, prices paid, that showed a lot of inflationary pressure when we saw, prior to the crash and then after the crash. Curious to see the prices paid is, really one of the most volatile numbers. And our PPI number yesterday spoke about this exactly the same thing as well, that the PPI on a year-over-year basis, including food and energy, is again the most volatile component. Same holds true here. The brown line, the prices paid was significantly higher. That has equaled out to the prices received. This is a good sign for manufacturing. So even though this number is bad, the fact that prices paid has come down to represent around the same amount as prices received, it means the profit margins for the manufacturers will improve or are improving. This is a 100-month correlation to the S&P 500 across all different segments of the manufacturing index coming out of Philadelphia. The greatest correlation exists in the prices paid and prices received. This is 100 months. This is a significant period piece of data. And we see here prices paid in red, S&P 500 in blue, very strong correlation indeed. When one line moves up, the other does as well. That's prices paid. Same situation, prices received, a very strong correlation. Will the stock market come back down to meet this line? That's anybody's guess. But when we see stocks go up and we see prices received go down, well, that should, kind of raise a little bit of a question in our mind as to whether the break in the correlation will continue. Now, we see here prices paid, prices received the current month. They're equally matched, and that's very, very good. Again, the prices paid the past couple reports, monthly reports, the red histogram was significantly higher. And when you see that the red histogram is significantly higher, again, it means that the profit margins are being squeezed, and that seems to show some sort of relief now. So these reports, although the Empire Manufacturing Index in New York is good, the Philly Fed Index is negative. Both, I think, show positive developments. And keeping in mind that the inflationary reports of the past couple days showed us there has certainly been a relief in the inflationary pressures. The concern is, well, as inflation comes down, will the jobs market come down? Will manufacturing come down as well? Well, at least as of today's report, I know the Philly Fed was negative, but the fact that the prices paid, prices received seems to have equalized. That is a good thing, I think. And therefore, I think overall, the manufacturing reports this week, there's a positive takeaway from this. And that, in conjunction to the positive developments in the inflation reports, so far, the news this week, at least so far, looks good. We hope this has been helpful. We look forward to seeing you back soon.